Ever wondered if a company can grow too fast for its own good? Today, we are breaking down the POLYCAB India Q3 FY26 review titled Record Revenue versus Margin Pressure, a Strategic Trade-off? We're analyzing if their massive growth is worth the hit to their profitability. POLYCAB just clocked its highest ever quarterly revenue of 7,636 crore, a massive 46% jump year-on-year. Profit after tax also climbed 36% to reach 630 crore. However, the EBITDA margin contracted by 110 basis points to 12.7% as the company prioritized domestic demand over immediate margins. The top-line growth is truly unstoppable. Revenue skyrocketed from 5,200 crore in Q3 last year to over 7,600 crore today. The real hero is the domestic market, which grew by 59% thanks to robust demand in India's infrastructure and housing sectors. The core wires and cables segment is on fire, generating the bulk of the company's cash flow. This segment brought in 6,741 crore in revenue, marking 53% growth. Interestingly, wires actually outperformed cables this quarter, maintaining a healthy segment margin of 12.1%. POLYCAB is moving beyond the cables into FMEG and EPC. The FMEG segment grew 17% to 488 crore, led by the solar category, though margins are thin at 2.9%. Meanwhile, the EPC segment saw more muted 4% growth at 407 crore with a 6.7% margin. Why did margins drop from 13.8% to 12.7%? It was a deliberate strategic choice. As raw material prices rose, POLYCAB deferred price hikes to protect its market share. Management chose volume growth and long-term dominance over immediate margin protection. There was also a specific one-off regulatory hit of 20.1 crore this quarter. This was due to revised wage definitions under new labor codes. Without this one-time expense, the company's profitability margins would have looked slightly stronger than reported. POLYCAB has built a literal cash fortress. The company boasts a net cash position of 3,032 crore and is virtually debt-free, with a debt-to-equity ratio of just 0.01%. This massive war chest provides a safety net for future acquisitions or major capital expansions. A major green flag for investors is their accounting quality. POLYCAB is generating real cash, not just paper profits. For the first 9 months, their cash flow from operations was 2,213 crore, significantly higher than their profit after tax of 1,923 crore. The company is operating like a well-oiled machine. Annualized return on capital employed improved from 27% to 31.8%. Additionally, they reduced working capital days from 44 down to 34, showing significant capital efficiency even while scaling their operations. What should you watch out for? Commodity volatility in copper and aluminum remains a risk if costs can't be passed on. Also, export revenue dropped from 8.3% to 6% due to soft global demand. The key will be seeing if margins recover in Q4. Let's look at the ZinvestZ scorecard. We have broad-based growth with a 46% revenue jump and a clean zero-debt balance sheet. Earnings quality is high, with cash flow exceeding profit, and efficiency is rising. The only trend needing monitoring is the strategic margin deferral. The final verdict is constructive. Record top-line performance and strong market share gains currently outweigh the temporary margin pressure. The fortress balance sheet provides safety while Project Spring continues to drive long-term growth. Did you find this POLYCAB analysis helpful? Make sure to save this for later and follow ZinvestZ for more smart investing insights into the companies that matter.